myriad ways to look at this Evergrande issue, right? But fundamentally, it's pretty clear that the priority is not going to be foreign investors and stakeholders here, right? Do you see the government being able to ring fence the situation?
Well, it's great to be with you. I do think there's further downside risk ahead for property developers, but I really do not see this as a systemic problem. So let's just start big picture. First of all, if you look at total loans, property developers are only 7% of total loans. And let's just take a look at Evergrande's debt in that context, which we think is around 41 basis points. Now, if you looked at bank loan loss reserves in the first half of the year, they were around 340 billion renminbi in the loan loss reserves. So I do not see this as something that is systemic, but it could be more industry-wide. So I am not so concerned about the contagion to the developed markets or even to the rest of emerging markets, but this is far from resolved. And I do think that investors have to be prepared that for foreign investors, you are going to see rising default rates, and maybe it's not just Evergrande, and there are more problems that could emerge in the sector. But I don't see this as systemic. And I do think that the government will do something that is more state-guided in this case. And we have to look at what's surprising and what's not surprising. I mean, China had been allowing more corporate defaults. This is just the size of this one is going to take time to play out. And I think they will look at prioritizing the workers. A lot of the domestic investors in the wealth management products, the banks will have to take on some of the non-performing loans. And I think the bondholders will take a hit. And they've kind of made that clear in the statements. But I think it will be state-guided.
You take a look at the pie chart that we just had up, and I wonder if we can bring that up again. What's quite interesting is just the lion's share of their liabilities is actually payables, right? It is not so much the debt side. So in that effect, is it possible for policymakers to be able to strike this balance of getting the suppliers paid, of getting these in development properties still being built, and so homeowners can actually get what they paid for, but still having that teachable moment that they won't be supporting moral hazard, and that the deleveraging campaign and the 3 red lines is still intact?
Well, I think they are going to have to walk a really fine balance here, because you still have that, they don't want to really have like home sale prices impact. And I think the market will look for is, whether, what happens with, the land value, and that could still go down quite a bit more. I mean, our analysts are looking at, could you see, land go down another, 15% in between now and the remainder of the year. So there's a fine balance. And I think they will actually, we have to see how this plays out. There's many different kinds of creditors involved in all of this, but I do think it will be state-guided. I think looking at the overall numbers, it's a question of how quickly the authorities and the PBOC reacts. The numbers themselves are manageable. Don't point to a systemic risk. And I think that, we have a situation here where it's, markets need to be prepared for, the further downside and, and perhaps standstill in some of these credits.
Joyce, for the global economy, especially when it comes to emerging markets, though, how problematic is what's happening with Evergrande, even if it doesn't really end up in a huge spillover everywhere? The fact that you have it combined with a Fed tapering that's to come.
Well, the Fed tapering, I do not see as being a major issue in all of this. I think, the Fed is effectively on cruise control at this point. I mean, Powell has actually made it very clear that it would take a serious disappointment to knock them off course. And this is something that we do see taking place before the end of the year, December in the official forecast, risk of November. And that's been widely expected. So I don't see the Fed as actually being a major issue in this particular problem. But the issues in China are more than just Evergrande. It's about the whole common prosperity agenda, and these are longer-term goals. So this isn't something that necessarily I would put a short-term time frame on watching. The market is still going to have to digest some of the high-frequency data in China, which has shown a slowdown. The possibility more R cuts in China. That's not really about Fed policy, but also just on the common prosperity agenda, beyond what's happening in Evergrande, that there's still regulatory tightening that I think still could play out further. Now, there's a real difference, though, between the equity and the bond markets. The bond markets have been pretty resilient here. Even the credit markets have been resilient than you would have thought.
What will the divergence between what the PBOC and the Fed are doing going to affect the markets and the broader global economy?
Well, I mean, I think if you take a look at just the growth differential, we are at a very multi-speed recovery. It's not a synchronized recovery. Now, we have Europe growing 10%. We have in the third quarter of the year for China, we've taken it down to pretty close to 0.2% growth. And in the US, where even just as recently as July, we were looking at 9.5% potentially for the third quarter, we have it at 5%. So 10, 5, 0. It's multi-speed. So it is not just all about the Fed. I mean, China is acting on a lot of its own domestic priorities, just given where growth is at right now. We've had a slowdown in consumption. Part of that is related to the Delta variant. So it's not just Evergrande. I mean, I think it is also the the growth rate that we're seeing in China had been slowing well before these problems had emerged.